And on today's show, how the discovery process works in the life insurance policy review. Part 4 of this week's series on life insurance policy reviews with policy due diligence expert and certified financial planner, Sam Rocke. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome to the show, Sam.
Thanks, Steve.
Wow, we're talking about it today. We're going to get into some of the basic ideas of the process, I mean, we've been talking kind of in the generic today. We want to kind of walk through some of this, and really, it's really good to have a process. 90% of our mistakes are because we don't have a track to run on. Right. And you have really constructed a track, and we're going to go through kind of a summary here. Walk me through this and help our advisors see what you do on a daily basis.
Right, so when we review a policy, we first start with the policy itself, and we say, okay, what are all the specifics in the policy, and then we're going to analyze how it's performing. And so we have a boilerplate here where we just summarize, okay, what's going on with this policy, who is the beneficiary, who's the current insurance company. This is very basic information. It's nothing all that exciting, but right here, the policy owner and beneficiary, sometimes that's something that really isn't understood. It's not very well, nobody really grasps that. And so it's always helpful just to review this. Whether they know it or not is a different matter.
Now, I see that your ownership is a ILIT, an irrevocable life insurance trust. Are you going to order a copy of that to look at that?
Sometimes we will, so it depends on who.
And if you do that, who reviews that? Do you outsource that, or is that in-house?
Right, we'll typically outsource it to an attorney from one of our insurance carrier partners.
Now, when I'm looking at the basic, you've collected the basic information. Now what you're going to do is you're going to start going through your checklist. You have this great checklist. Walk us through that.
Right. So yeah, at this point we're going to look through the projection data, and we're going to say, okay, based on current assumptions, based on all of they continue to pay their current premium, how is this going to look? And so we're going to look at here. We decided, okay, the best way to do this, and we have 6 really experienced people who are saying, okay, what is the best way to look at this? What would I want to know if this was my policy? And so for this particular contract, we said, okay, just as is. And we always start with as is because it's what they're currently paying.
Oops, sorry.
And so the as is says, what happens if I continue to pay my current premium, which most people are going to say, well, I want to continue down the road that I'm currently on. I've been doing this for years. And so with this I think she's 72, 76 years old. Her policy is guaranteed for 16 years. So she looks at this and says, man, my policy is going to lapse. It's on a projected and a current basis, or a projected and a guaranteed basis. So we say, okay, what happens to this contract if she continues to pay her current premium? And if she does, there could be a time out in the future where this policy lapses. It runs out. It goes away. And so all the premiums they put in that contract are going to be essentially wasted. So we're going to say, all right, if we want to fund this thing to maturity, the longest possible period we can with that carrier.
Now, when you say maturity, I notice you have lifetime here, but do you mean lifetime, or are you saying age 100, age 120?
So
what are we talking about?
With this particular contract, it's you pay to 100. Once it gets to 100, it automatically guarantees to maturity. So, yeah, you get to 100.
It's in the contract, not
right?
a current
It's in
company
the
practice.
Correct. It's in the contract. As long as there's sufficient cash value at age 100, it goes to 121, or basically what they probably write it in lifetime in their contract. And so we say, all right, what does it take to get it out to lifetime, or the longest period of time? And it's basically a 50+% increase in premium. So a client at that point might say, oh wow, is there another alternative? And so we say, all right, well, it happens if you don't pay any premium, just for the heck of it. And it only lasts for 9 years, 5 years guaranteed. So there's some things that the carrier could even change to make it only last for 5 years.
From a guaranteed contractual.
From a guaranteed contractual.
Now, this is the front end of your process. As is, funding to maturity, in this case, age 100, with a contractual imperative to take the endowment all the way out to the lifetime of the client. And then let's not pay anything and see what the guaranteed and the current assumption is.
Right.
And you do that for all this? This is your process?
Correct.
I don't know of anybody that does what you just said. And I've been in this business 30 years. So this is a huge gauntlet and a process to go through.
Right.
Now you start to do life expectancy evaluation as well.
Yeah, and this is to be honest, this isn't incredibly specific, but it does assume the mortality tables, and really all it does is put in perspective. Okay, how long does this 16-year projection, 16-year guarantee really last? And with this, we say, okay, based on the current valuation table, the current life expectancy tables, we say, all right, what is the probability that you outlive this? And so based on the as-is scenario of 16 years, there's actually a 40% chance that she's going to outlive the contract. So basically it's a coin flip. So you say, okay, if you continue to pay your $40,000 a year, there is a 40% probability that your insurance is going to go bust.
When you have a client, you tell them that based on life expectancy, what is the general response from a consumer?
It's a little bit varied. If you say 93, sometimes a client will say, oh, I'm not going to live to 93, but the reality is a lot of people are living to 93, and they don't really have that much control over it. And I think you get a lot of beneficiaries of policies, like the children of the client, who say, look, I don't want that sort of perverse incentive to say, you know, if my mom is at 92, they say, oh, if she makes it one more year, this insurance policy, this $2 million policy is going to lapse. I hope she doesn't, or I think they would prefer not to have that conflict.
Or the conversation.
Or the conversation.
We come back, we're going to talk a little bit more about life expectancy and move into the last part of the actual process, which I think is very enlightening. We'll be right back. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. We're with due diligence and due care expert Sam Rocke. We're talking about life expectancy. I mean, this has become almost a crapshoot because really, when you look at the 2001 CSO, a female 84 is the average, but that really means that half of them will outlive 84 and go on. I just looked at the actual Guinness tracking for the next world, oldest person in the world. Jean Clement died at 122 years, 164 days. There are 21 tri-centurion teenagers, 113 to 119. So this isn't out there. And Willard Scott says, happy birthday to a handful of Americans that turn 100 every day on the Smucker's jar. Yeah. So when we think about centurions, this is not going to be like an anomaly. This could be the largest growing population of the geriatric market.
Right.
We're looking at life expectancy, and back to this same thing that we talked about in the first segment. We look at this. I said to you when off camera, I said, but what if they live to 93 and she's still living? There is a premium they could pay.
Right.
But it could be what?
Oh,
huge.
5 to 10 times what they're currently paying.
So it's not like they're going to lose its lapse, but you would have to pay a premium. If you saw that coming and you had 10 years, would you start maybe overfunding the contract to see if we could push it out while we got cheaper COIs?
Absolutely.
Have you recommended that, and have they taken that option?
Right, absolutely, yeah. We're going to, typically if we're going to look at this and say this is lapsing ahead of time, we're going to say, let's get it back on track. Let's get it to a place where you're comfortable with the duration that the coverage is projecting.
And remember, keep in mind from an advisor point of view, many times we are myopic in our approach with policy owners and policy insureds. But remember, the beneficiaries are the ones that are going to be hurting on this. It's possible that you would take your children as an example, and they might say, hey, we'll split that premium 4 ways.
Right.
So it's not a done deal just because this looks over, you can't overcome these numbers. Sometimes the actual beneficiaries will step up at that last point and start to pay. But I'd like to do it before that happens.
Oh, absolutely.
Now, when you're looking at some of this, we're looking at the table expectation comparisons. Walk me through this slide.
Right. So this puts a little bit of, this quantifies exactly how much the life expectancy tables have changed. If you look at the 1980 mortality table, which this old John Hancock policy was based off of, she had a life expectancy at the time of 82 years old. So in 5 years, she's going to be past that.
Was she standard at that time?
She was.
So that was standard. And what was their actual issue when you did the new policy?
I think it's preferred.
So this is amazing, and this is why I want to bring this up. You can have standard 10 years ago, and people say, well, it'll never be improved. Right. Because people think in those terms. But really, you see an upgrade in underwriting classification sometimes,
for sure.
And it's worth looking at. Wow, we went from an 80 CSO and standard to a 2001 preferred, and it bought her 9 more years.
Right, yep.
Wow.
She now has a life expectancy of 91.
This is why I think it's critical, and I know that Sam's team is one of the few teams in America that actually do life expectancy table comparisons. It's really important, especially when you're dealing with maturity dates, lapses, guarantees going all the way out to X. These are really important issues. Walk me through the old policy and some of this, because this is where the real gold is.
Yeah. So to really put some numbers to it here, look at the policy charges. At age 75, based on the old pricing, she's paying $21,000 a year in cost of insurance charges. Here at the new pricing, it's $18,000. But even 20, 30 years ago, it's on the whole, it's at least 10% more expensive based on these old 1980 numbers.
When you think about the lapse ratios, the actual death claims that we've experienced, and this new pricing, this is why we do policy reviews. This could be such an impactful issue, and especially as we talked yesterday in the fiduciary market, we're always trying to get into gatekeepers like attorneys and CPAs and trust officers. With this kind of information, to me, this is like the dessert, the icing on the cake, talking about life expectancies. Now, when you've done all this, now we've walked through the process, what you do, now you have the ability now to start shopping. I mean, you're going to start shopping for people. You knew, hey, I think I can get this person a preferred, even though she was formerly a standard. Now, when you look at that, what are you looking for on the new contract? Do you already kind of have a guess who the players are going to be?
Sure. There are carriers who are fairly aggressive in their pricing at a certain time, and the carriers that really aren't. And so ultimately, when we see a case like this, it typically triggers a few ideas in your mind of who the players are going to be, both from an underwriting perspective and a pricing perspective.
Well, let me ask you this, Sam. We have a huge gauntlet. We have an inventory that is so huge. But when you see this, what are you really looking at in your mind? By the time you go through the process, is your head down to about 5 to 6 carriers?
Right. So typically, our IMO has 80 plus carriers that we have access to, but ultimately we have 10 to 15 really good partners. There are carriers that are financially strong, there are carriers that give us good underwriting results, that give us access to resources so we know who to talk to. We can go directly to the right person to talk to, rather than just going through we have leverage with those carriers. And so ultimately, we'll as we're thinking about this, we say, okay, there are 4 or 5 carriers that are probably going to fit the criteria on underwriting, product, and just overall level of hey, can we get this done, and can we get this done in a reasonable way? So that's how we're ascertaining what carriers to recommend.
Huge issue using life expectancy. Very few reviewers are using life expectancy tables. It's a huge advantage if you are on the look at reviewing policies. Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives, and remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.